And let's dig deeper on our top story. Shares of Credit Suisse closing deep in the red today after the bank's largest investor said it would not provide any more funding. This is just the latest development in the financial sector following the collapse of Silicon Valley Bank and Signature Bank last week. Let's bring in Matt Maley, Miller Tabak Chief Market Strategist, for more on this. Matt, let's start out with the major difference between Silicon Valley Bank and Credit Suisse, specifically when it comes to derivatives.
Yeah, I mean, the banks are certainly important banks here in the U.S., but you look at what's going on with Credit Suisse. I mean, they have a huge derivatives book. And you think about that, they have banks all over the world, investment banks and large commercial banks who have big derivatives positions, and they're the other side. In other words, this brings about counterparty risk. And you could have the strongest bank in the world, but if they think they've got a hedge on, and Credit Suisse is the other side of that trade, and suddenly Credit Suisse disappears, that just throws a major wrench into the works of the system. So that's a very concerning, and that's why I think people were so much more worried today. However, at the same time, it also means that they're probably too big to fail. So I do think at some point, the Swiss National Bank will come in and make sure that they don't go under, because there's just too much. We're almost guaranteed a contagion taking place if Credit Suisse goes under.
Yeah, certainly that would be massive implications there across the board, obviously on a global scale. Matt, when we talk about the fact that the situation here could lead to banks tightening their lending, what is the potential fallout on that, not only on the banking sector, but more broadly speaking when we're talking about the economy?
Yeah, that's the whole thing right now, is that people are like, oh, geez, are we going to have a banking crisis? Well, look, I don't think we will. Well, certainly not what we got in 2008. But that doesn't mean it's necessarily out of the woods. I remember last January is 2022, people were saying, don't worry about the tech stocks because they're nowhere near as overvalued as they were in 1999 and 2000. I was like, well, that's fine, but they're still really overvalued. And so the same thing here is that we're having a banking problem, maybe not as big as it was before, but that doesn't mean it's not a problem. If they pull in their horns, we already see what's going on with private equity and venture capital. They have much less money to spread around. So we're going to get the innovation industry we see is already starting to shrink. They're just not going to have as much money for those private equity and venture capital firms. The banks are going to have tighter lending standards, et cetera. That's going to slow growth down. So we're all going to start worrying less about whether we have inflation or not, and more about whether we're going to have a recession.
And to that point, Matt, whether we're going to have a recession, I mean, I'm looking at year to date, the NASDAQ is up 9%. We have a Fed decision next week. The possibility perhaps is now floating around of 25 basis points or perhaps no rate hike. Do you think the markets are pricing in a recession here?
I don't. I mean, the bond market is starting to, because we've seen this major rally in bond prices, which has caused interest rates, of course, to fall in a significant way because they're worried about this. Now, of course, again, part of that is also because of a flight to safety and concerns over the banking sector. But some of it has to do with the concerns about the economy and the economy slowing. So the bond market's starting to price it in. But the stock market at 17.5 times earnings, almost 18 times earnings, and 2.2 times sales. That's not the kind of valuations that is pricing in a recession. I hate to say it, but every bear market for the last 70 years has not bottomed until it got to at least 15 times earnings. So that's when you start to price in recessions. And so we have further to fall, I think, before the stock market fully prices in the way the bond market is starting to do.
Well, Matt, how much lower then do you see markets potentially going when it comes to equity market? Well, we closed the S&P just below 3,900 today. What are those key levels that we need to continue to watch?
Well, on a technical basis, everybody's going to be looking at this 3,800 level or just below, about 3,775. That was the closing low back in December. And, that would give it a lower low if we broke below that level. But it would also mean that we've failed to break out above the 200-day moving average. We've rolled back over. That would really confirm that the bear, a new leg of the bear market is starting, in my opinion, 3,800. But again, to answer your question more directly, we had those lows in the 3,600s back in October. I think we'll have to break those because, to get down to that, what we usually see is even just to get to fairly valued, we've got to get down to about 3,400 in the S&P. And usually the stock market, when we in a bear market, it almost basically always overshoots to the downside. So that does leave us a little bit more downside. Now, again, that may sound really tough, but when you get a market that it was so overvalued, it does take longer for us to work off that froth like that had built up during the pandemic.
And what would be the catalyst to work off that froth that you're talking about? I mean, we have seen what's been happening in the banking sector. What concerns you? What do you think could break next?
Well, I think one of the things is we're going to start to see some of these numbers start to come down. I mean, think about what's happened to confidence here. Consumer confidence has got to be rocked at least a little bit based on what's happened recently. And of course, for 70% of the economy is the consumer. They start pulling on the horns. That's a little bit of a problem. But I think the main catalyst will be we're going to start to see the cutting of earnings forecasts. Right now, the S&P forecast is for about 220, so that would be basically a flat or slightly higher. As that starts to move down, I mean, a lot of people have been saying that there'll be about $200 instead of the $220 we got for the S&P 500 last year. If you get down to that $200 level, and suddenly, with bank earnings certainly going to be cut, the tech earnings going to have to be cut further. There's a good chance we get there. So I think it's going to be, as in the next month or so, we're going to see more cutting of analyst estimates, and those lower earnings are going to start to scare people a little bit.
So, Matt, we certainly have seen the nervousness play out in the equities market. What do you make about what's been going on in the crypto market, more specifically Bitcoin? Because, yes, Bitcoin was under pressure, is under pressure today, but over the last 5 days, still up just over 18%.
Yeah, I mean, some people are saying this, that maybe it's a flight, that it's going to be, that it's a flight to safety trade. I think it probably has more to do with the fact that the Fed is almost certainly, adding some liquidity to the system behind the scenes. I mean, they're not suddenly starting a new QE program or anything, but I'm sure that the QT program has been pushed to the side this week. So a little bit more liquidity into the system, that certainly helps. But it's also been, this concerns about banks is getting people more bullish about the possibility that we'll need a cryptocurrency type system. We'll see what happens with that. I'm a little worried that whatever we come in with a cryptocurrency is going to be a federal one rather than an independent one like Bitcoin. But we'll have to see with that. If Bitcoin can get above 25,000 and finally stay there, like it did, it got there for a small amount of time yesterday. If it can get above there and push higher, that I think would give people a lot more confidence that it's going to go. We're finally going to see a bit of a rally here.
All right, Matt Maley, always great to have you. Miller Tabak, Chief Market Strategist.